Welcome. We're going to introduce today the publication that you'll see on the tables, which is called Winning in Growth Cities. I'd like to introduce my distinguished panel here. David Hutchings, Head of European Research. John Stinson, Head of Asia Pacific Capital Markets. And John Busi, last but not least, Head of Valuation Advisory for the Americas.
The key trend is that the concentration and interest in the biggest cities globally has remained in place, and those cities pretty much remain the same ones this year as they were last year. As you can see from the slide here, New York strengthened its lead at the top of the rankings. London was second, Tokyo third. Paris had a good year, strengthening its hold on fourth place. And then we had LA and Hong Kong in fifth and sixth. If we broaden that out and look at the top 25, though, we can really see the concentration that exists in the market. These top 25 markets saw something like 6% growth in volumes last year, compared to the market as a whole, which was less than 1%. So they've increased their market share, taking it to about 56%. And when you think that the top 25 cities globally by population account for less than 10% of the global total, you can really see how concentrated interest in the property market is. 21 of these 25 are the same as they were last year. This, for example, is just the top 25 by number of cities. And you can see the Americas had 14 out of 25. Firstly, New York and London are really the only cities that feature in the list for scale and the list for innovation, culture, etc. So their place at the top of the table for business and for property investment is not going to change anytime soon. On the Americas, strong presence, as I said, LA, San Francisco, Toronto, all top 20 cities across a wide range of factors. Latin America has much less presence, but I think it is worth noting that in particular Mexico City and Sao Paulo are moving up very quickly. Now 2013, of course, is not going to be a year of growth. I can't stand here and tell you that, unfortunately. But if, and it is of course a big if, the politicians were to get their act together, then it could at least be a year of stabilization. And when I say the politicians, I'm not just talking about here in Europe. Obviously, we're talking about in the US, we're talking about in China and other parts of Asia as well. So it is a big if, but if that happens, it could be a year of consolidation, and that will actually be good in as much as it will signal the start of more activity from banks, from businesses, and from investors. I guess the final point we'd make at the global level is wherever we look, prime values have been well maintained. It is, as the Americans like to say, a bifurcated market, but we will see some spreading of demand away from prime towards the best secondary, but that's only going to be where it offers an attractive solution for occupiers.
The top market in the world right now is New York, and the top 5 out of 10 markets, LA being the number 5 market, San Francisco the number 7, DC number 8, Chicago number 9, and Toronto number 10. But if you look at New York, we're back to pre-2007 levels. We're looking at cap rates that are anywhere from 3.5% to 4.5%. We're seeing a couple of billion-dollar transactions in the market, sales that are exceeding $1,000 a square foot. So clearly, when you look at core markets, when you look at a market like New York, or if you look at San Francisco, LA, and even DC, we're seeing pricing that's returned to pre-recession levels. In terms of targets for investment in 2013, you look at the cities up there in the CBD markets, you look at New York and San Francisco, Washington, LA, Chicago. Right now, they're accounting for about 50% of all the transactions that are taking place. So again, there's as David mentioned in the preamble, there's a very bifurcated market in the States right now. There's very patient capital, long capital that's looking at the core markets and looking at very low returns right now. And then there are the other markets in the country that aren't witnessing an influx of capital, and those markets seem to be a little bit of a question mark right now. As we were starting to see some strengthening in the recovery in the US, we started to see that bullseye get a little bit more expanded, and we started to see investors looking at suburban markets or CBD markets that had some leasing risk. But that seems to have stalled a little bit. It's appearing right now that it's coming back a little bit. But if the markets pick up a little bit of momentum, I think we'll see some good news for 2013.
Top picks for core, London. Anyone for London? I think everyone is for London. I mean, if you look at the diversity of capital flowing into London at the moment, it is absolutely staggering. Really, it is the touch point for all foreign capital, whether it's Asian, whether it's US, whether it's South American, increasingly. Pension funds coming out of Brazil and Latin America. London is the touch point, followed closely by Paris. It is rare that trans-regional capital gets to Stockholm, Munich, Frankfurt, Amsterdam. I wish they would, because although they're not global megacities, they have a lot to recommend them. Berlin is increasingly popular with tenants and investors at the moment, and is rapidly moving up the city rankings. Munich, of course, where we are. Amsterdam is absolutely in our top 5 European cities in terms of innovation and in terms of quality of the labor force. Don't forget about Moscow or Istanbul. Moscow, frankly, is in the top 25 of global investment targets, global investment volumes. It is rapidly becoming a substantial business hub. Istanbul probably a bit further off, but really, if you're comparing the European cities to the Asian megacities, London, of course, competes, Paris competes, but pretty soon you'll be seeing Moscow, a little bit further down the line, Istanbul. Occupiers are actually reasonably positive at the moment. They are often taking advantage of the current distress of their landlords to buy back their buildings and release them. And we're seeing a lot of interesting transactions where you have shorter lease buildings which are perhaps unfinanceable, and we are buying those buildings on behalf of the tenant, putting a longer lease on, and then selling them back into the investment market. Basically, prices for strong grade A. If it's in Germany, it's wonderful. If it's in, if it's in Munich, it's even more wonderful. And there's huge demand for grade A assets. At the other end, the difficulties in financing secondary assets are really continuing to push secondary prices and yields. These days we don't talk about yields, we're talking about price per square meter, price per square foot. And the same as the Americans used to do, we're talking about substantial discounts to replacement cost. And we never thought we'd get there, but we are, definitely. I would encourage anyone who has the strength of mind or stomach to consider Moscow. It really is by far the most dynamic office market in Europe at the moment, much more so than London and Paris. If your business is building or buying grade A quality office buildings, then you should not ignore Moscow.
By sheer virtue of size and scale, it's no surprise that the Asian cities in the top 25 have retained their rankings. Overall, Tokyo is still the strongest city in the region, and overall it retains its 3rd global ranking. Hong Kong, of course, is the highest ranked Chinese city. A lot of people misinterpret that as Shanghai, but Hong Kong definitely this year. And interestingly enough, all East Coast Australian cities now appear in the top 25. I think one of the interesting takeaways this year is that a lot of people have thought that Asia has escaped the Euro crisis and the global malaise. That's definitely not the case, and we're certainly seeing that in these figures now. The answer for Shanghai bouncing back, Hong Kong to an extent bouncing back, is both those markets actually saw a contraction almost 18 months ago. So what we're now seeing is more transactions, really by virtue of the fact that there's more opportunities in those markets available. In terms of Asia, what we are now seeing is by virtue of the fact that we have seen a very quiet 12 months in terms of volume, we're actually now starting to see a higher number of opportunities come on the market, better quality, and with that, we certainly start to see transactions. We're seeing that now in this 4th quarter, and that will continue into 2013. In terms of opportunities, very similar to the Americas and also Europe, we see continuing focus in office on the core markets, which are really Tokyo, Shanghai, Singapore, and Sydney. Next year, we will see that start to expand to some of the emerging markets, Kuala Lumpur, Jakarta, Mumbai, Bangalore. Retail and hotel are favoured sectors in the region in terms of the volumes. When you read this report, the volumes bear out the interest and bear out the underlying factors as well. So we see final quarter, more transactions, and definitely a much more positive 2013.
Thanks very much.